we're about 3 minutes to the closing bell, and we are still watching these markets trade down. S&P 500, the Dow, and NASDAQ all in negative territory. Greg Staples is the head of fixed income for the Americas at DWS Group. It's good to have you here. And as we head to the bell, what's the greatest influence on what we're watching in the market today? Is it this debate over whether the Fed needs to tighten sooner than later, inflation, or is there something else at play?
I think you actually nailed it on the head. It's a little bit about what the Fed's going to do, but it's what's going to cause the Fed to do something. And I think Powell's been very, very clear. He's not going to do anything unless you see unemployment get back down to the levels that it was pre-COVID, down to that 3 handle, maybe 4%. And at the same time, see inflation go above that 2.5%, that flexible average inflation target that he's looking for. And he doesn't think that's going to happen until 2022 at the earliest. So we might have a while to wait.
Greg, do you think there's any reason to believe that maybe the Fed is being a little bit too patient on this and that they should potentially be acting sooner than it seems like they will likely act?
That's the big debate in the markets right now. There's the Powell camp that says, no, we're going to see some inflation over the next 2 months, 3 months. There's no question that's going to happen. But then he's going to say it's only transitory. It's really going to calm back down again in the third and fourth quarters. So just be patient. I think there's other people on the other side who say, no, this is a little bit more permanent. There's some things that are going on with supply chains. The commodities are hitting an all-time high. It's going to be difficult to bring workers off of their couches and into the labor force unless you pay them more. Look at what's been going on within, say, used car prices or housing prices. That's going to work its way through, potentially more structural and more permanent. And that's the big debate that's going on. Which side of those two is right?
All right, we're going to count down to the closing bell. Let's check markets and see where we are at this point, because you can see that we are trending down. The Dow is off 86 points. The S&P 500 is off almost 9 points, and the NASDAQ is off about 5 points. In the Dow today, some of the winners have been Boeing and Walt Disney, United Health Group, Home Depot actually up about 0.5%. We got the Case-Shiller price index, the S&P Case-Shiller home price index, and we saw that demand for houses still very strong, that people still willing to pay the prices that are going up now 13.2% over the last year. So we're keeping an eye on that. Home Depot obviously benefiting from it. Also Boeing benefiting from new orders, but also the fact that the airlines like United have told us that their domestic leisure travel is approaching the same levels that we saw in 2019. So that's where we stand as we go to the closing bell. Let's take the shot.
And that does it for the trading day today. Again, it looks like we're closing in negative territory at least, or maybe looks like negative territory with the NASDAQ just below the flat line. I was a little, too optimistic there, thinking that we might flip over into positive territory. The S&P off just around 0.2%, where it's been for the last hour, and the Dow off 82 points. Like Adam was mentioning, we saw some of the momentum exit the market earlier today. We were posting earlier gains. Big tech had a lot to do with that, although some of those FANG names closing the day mixed. The reopening trade, some of the cruise lines and some of the airlines there buoying the market are helping investor sentiment just a bit, providing some broader market support here. But just in terms of the major averages, you're looking at losses here for all three. We want to bring back in Greg Staples. He's DWS Group Head of Fixed Income Americas. And Greg, let's look at the bond market. I know you follow that very closely. We see the 10-year yield pulling back just a bit today. We haven't seen a lot of action, or maybe it's been a little bit more muted than what we would be expecting when we talk about this inflation debate over the last several weeks. Why do you think that is?
It's interesting. We had a huge sell-off in the first quarter, obviously. One of the worst quarters for bond performance in literally 30 years. And now I think we're in a bit of a digestion period. You're right. We've been going sideways on the 10-year Treasury from a range of 155 to 170 for almost 8 or 9 weeks now. And we could continue to see that over the next couple of weeks. But once you get deeper into June, maybe see a little bit more data. Perhaps even the jobs number a week from Friday could be a catalyst for something. Remember the one last time around was much weaker than expected. The market didn't move too much. The CPI number, inflation number, that came hotter than expected. Market didn't move too much. We'll see PCE this coming Friday. We'll see the jobs number a week from Friday. And as we get more data that says perhaps we are really overheating, that might be a catalyst to push rates higher, which we think is actually going to happen.
Greg, you are the person who is on the front lines of this daily, but I got to ask you, we haven't broken out of that resistance on the 10-year. I mean, 1.69, 1.7. So why should the people listening to us right now share the concern you have that we do break through that and go higher?
Well, at the end of the day, that's actually what Powell wants, right? I mean, he says he's not going to do anything until he gets inflation up to that 2.5% rate for over 6 months. And so you're fighting the Fed, actually, if you think that inflation is going to get lower than that. He's really going to do everything he possibly can to stimulate it. And when the economy is overheating, you're talking about potentially 6% growth in the second quarter, maybe even 6% growth in the first quarter, maybe even 10% growth in the second quarter. We've got a lot of momentum here. And he's continuing to add stimulus on both the monetary side and then with Congress and the infrastructure plan on the fiscal side. So we think everything's on a go for continued growth, and ultimately that's going to lead to more stable and systemic higher inflation, which will ultimately lead to higher rates.
We want to get back over to Jared Blikre on the floor of the New York Stock Exchange. And Jared, I guess, what are you hearing from traders here as we wrap up the trading day?
Well, there's not a lot of action right here. It says this still this summer, but the traders that I've been talking to today have been talking about GameStop and AMC. They had that late afternoon surge. That was pretty interesting. So one of the fellows over there DM'd me about that, and I tweeted it. Other than that, there's not a whole lot going on. You look at the rolling price of Bitcoin, still pretty volatile. It seems to go up 8%, down 8%. And you take a look at a lot of the crypto stocks, those are still in negative territory over the last month or two. But things have perked up for a few different markets. I am looking at the semiconductor space, a lot of positive signs there. I think it was Applied Materials, one of the leaders today. And then we get NVIDIA earnings after the bell tomorrow. It's ready to break to new highs. We'll have to see if that can happen.
All right, Jared, we appreciate that. And we also want to thank our guest today, Greg. It was good to have you here. Greg Staples is the DWS Group Head of Fixed Income for the Americas. We look forward to when you come back.